Welcome everyone. Thank you for joining us today for this webinar. My name is Samiksha Loya and I'm the Marketing Manager at RNM. I request for your active participation throughout the webinar. If you have any questions, you can please share that in the question and answer box. We'll also have some poll questions which you can answer to make this session interactive. Now, I would like to hand over to Mr. UN Marva, Senior Partner at RNM for the welcome note.
I extend you all a very warm welcome to the panel discussion on startup funding in India, which is being organized by RNM India under the leadership of Raghu Marva. RNM is a consulting firm operating in Delhi for the last over 75 years, spanning 3 generations. And we presently have our branches in Gurgaon, Bangalore, Raipur, and London. As the post-pandemic market drives adoption of technology, solutions by businesses and consumers, the funding for Indian startups continue to exhibit user and revenue growth is expected to continue rising in 21 and 22. Interestingly, fintech, enterprise tech, and edtech startups in India have spearheaded the funding bull run in 21. Before we begin the webinar, I would like to introduce and convey my gratitude to all the panelists who have joined us to share their experience and expertise. Thank you all. I hereby welcome Sunil. Sunil is a qualified chartered accountant for over 28 years of financial experience in services and consulting. He was associated with Jacob Ballas Capital for 2 decades. Prior to that, he was head of corporate finance for Tata Finance Limited, one of India's leading NBFCs. Welcome, Shruti. Shruti is a co-founder of Stashfin, an app-based digital lending venture started by a team of former financial service professionals. As an accomplished financial expert, she has led strategies for top banks and spearheaded a family business, apart from launching 2 successful startups. Welcome, Mr. Peer. Mr. Peer has more than 35 years of diversified experience in the financial sector and heads the consulting division of RNM. RNM Consulting is a firm providing virtual CFO, payroll management, ESOP. Prakash, and welcome Prakash, heads the tax division at RNM Bangalore branch and has 15 years of experience in the field of corporate and international tax and GST laws. He advises domestic and multinational companies on various tax matters, including tax structuring, due diligence, and compliance aspects. And last but not the least is the host, Raghu Marva, who is the managing partner of RNM India and is leading the firm. His expertise is on advising and structuring businesses overseas on behalf of Indian corporate clients, entry strategy to foreign clients who set up business in India, transfer pricing, and overseas taxation matters. I would now like to hand over to Raghu to moderate the session. And I'm confident we will find the panel discussions enlightening and thought-provoking. Thank you all for being with us today, and all the best.
Thank you so much for those kind words, Mr. Marva, and for giving us this opportunity to start and present the webinar to you. With that, I'm just going to start with my opening remarks on the startup funding in India. As you're well aware, it is an amazing time to be a startup founder. In the week from 6th of September to 11th of September, an aggregate of $768.5 million has been raised by Indian startups, with an aggregate of $20.2 billion raised so far in the calendar year 2021. So these are staggering numbers in themselves. And I thought it'll be of interest to everybody to to understand, why we picked this topic, because clearly anywhere you go, this is kind of in your face and unavoidable to talk about startups these days. Indian startups, incidentally, have also beaten China on the funding race for the first time in the month of July 2021, with China grappling with their regulatory crackdowns by the government. It's, like I said, another good time or good excuse for an Indian founder to raise more money. Raising money is always a tricky question as to why should you raise, how much should you raise. So my mantra is you should raise as much funding as is required to reach profitability, right? Because when is the next round? How soon you will need to raise that? So you must have a clear runway to profitability and try and raise as much as possible to reach that level, so that you don't have to constantly bother about the next round and when my next investor is coming in. As a founder, you can focus on building the organization, and that is obviously the ideal scenario. But we don't often live in ideals. So I would like to, at this point, share an interesting anecdote from a successful unicorn founder called Mr. Ashneer Grover of BharatPay, who had once said that he had to actually pledge his home to be able to successfully close his first seed round, right? And this is in spite of him being a serial entrepreneur, having all the experience and background that is required of a founder. And that kind of really struck me somewhere as, the amount of conviction that a founder needs in his startup is unbelievable, because you really need an all-in approach to be able to convince other investors that, yes, this startup or this founder really has it in him to take it to the next level. So I think that is the kind of, you're by definition putting the bank, you're putting the house on the block, right? So it couldn't get any more of a risk taker than that. And that's kind of representative of the whole ecosystem, I think, that we live in today. And from a founder's point of view, either you have a great network, or you go to an angel or an incubator or an accelerator platform to be able, or then an investment banker to be able to raise funding. But today, I thought, let me try and call the art of startup as the art of the start, where he calls them not friends and family, he calls them friends, fool and family, because the fools somehow always get stuck between the friends and the family. You go around trying to raise money. And then, of course, after the three Fs, as he calls it, you've got the angels, you've got the foundations, you've got the P2P platforms, you've got the venture debt, VCs, IPO now, which is becoming exceedingly hot in India. So these are some of the other avenues that a typical founder has. But again, let's try and analyze from his point of view, what are the steps that he needs to take before he goes out there? He needs to assess what is the amount of funding that he needs. Like we talked about earlier, what is the runway to profitability? What is his go-to-market readiness? Is he really ready to absorb all that money? What is his pitch deck? Is his pitch deck a proper pitch deck? Is important? Has he got that ready? Who are his target investors? Has he identified some potential target investors? Has he done some sort of a potential due diligence, that will help him when the actual potential investor does the due diligence, the term sheet that needs to be prepared, and then finally the definitive documents that need to be executed. So these are, some of the steps that you go through. And then we talk about, what is the kind of typical dilution that you need to do, right, at a seed round. Is it, the 10% or the 20% or the 20%? So at a seed round, typically you're at a loss, right? You're still before proof of concept. You're very, very often relying upon the goodwill of others and them trying to judge, the founder rather than the business, because the business does not typically have traction at a seed round. So it's always a tricky how much you need to dilute. So I think hopefully during the course of this webinar, you will be able to get some of those answers from the experience of the panelists over here. And then we talk about some of the more commonly used instruments. You have something called the SAFE instrument or the KISS instrument. SAFE instrument, the investor world loves acronyms. So SAFE is an acronym for Simple Agreement for Future Equities. And KISS is an acronym for Keep It Simple Security. So these are typical security standard documents which have been made by companies like Y Combinator or 500, and they put them out there as models for all founders to adopt, which are basically convertible debt instruments which go in an unpriced round, typically used at the seed stage where the valuation can be very controversial, right? So these are some of the simpler documents which are out there in the public domain, which a founder can just use to try and raise funding on his own. So that is something else that I wanted to share. And then I'm just going to quickly run through the various stages from Series A to Series D. I've got a lot of literature here, but I'm just going to quickly run through how a typical Series A runs, right? A typical Series A, would be anywhere between, between $2 to $15 million. Today, of course, people are raising up to $25 million in a seed round, but the typical seed round is anyways between 2 to 15 million. And this is, like I said before, a proven, business model. The plan is being under development. Then you come to, the Series B round, where you're typically raising between 20 to 40 million. And the company valuation then bumps up to, say, between $30 to $70 million. And at this stage, the venture capitalists are kind of interested because now you've got your product market fit done. You need basically help in expanding, and therefore you're typically raising a Series B. A Series C then is again that you've done everything right. You're doing very well. You basically need to expand into newer markets, right? So you may need to expand into newer markets or acquire newer businesses, develop newer products, and therefore you're typically raising, say, a 50 million plus kind of a Series C, and your valuations have again hit the 100, 120 million plus kind of numbers. And, these again are changing because, you've got so many unicorns. By Series C, they're already thinking IPO, and they're going to cross or skip the Series D and subsequent. A typical Series E, a startup who's already reached a Series E round, is somebody who's either gone through some troubles and they failed to meet expectations, and therefore they're still on that series ladder rounds rather than going straight to IPO, but they need a little more help to get to the public IPO stage. That's what kind of hits the Series E guy. But I think with those couple of words of my introduction, I thought I'll just kind of break it down before we dig into deeper or lay the kind of foundation. I just wanted to share what RNM is doing in terms of, we've had 5 physical masterclass events so far. This is our 5th webinar series, since the pandemic has begun. And now we've recently started these how-to series, right? How to raise money, how to scale up. So we're trying to make things simpler, right? Going from a very technical masterclass, now we've kind of come to the webinars where we're trying to break down things and make things simple for a simple layman or a simple non-technical person. And, with that, I'm just going to request everybody who's there to, after this webinar, maybe give a like to the RNM India on YouTube page or the social media page to keep on following and getting access to this great content. With that, I'm going to request our first speaker for the day, Shruti, who's a dear friend and like I said, the founder of Stashfin, to make her remarks about how her personal experience has been, and growing a disruptive digital lending venture obviously comes with its pluses and challenges. So over to you, Shruti, for your thoughts on that.
Thank you, Raghu. I mean, all the points you've raised, friends, family, fools, in whatever sequence you want to put it, that's where everyone starts. And that's exactly where we started. Thankfully, coming from professional background, had enough networks. I'll quickly give you my background so that you get a sense of how we started Stashfin. So I'm Shruti. I start, by way of background, a chartered accountant. Did my articleship with Raghu at PwC. So we go back, I don't even know how many years now. Don't want to count either. Post that, went to do my master's at Columbia University. Spent some time in the US working with in an investment bank with Merrill Lynch. Post that, started the, Amazon was coming live, Uber was coming live. I wanted to try my hand in startup as well. Did that earlier on in US itself. Moved back to India, took some time off, and then got the opportunity to join Stashfin. My prior to startups were all about retail, but I could never get finance out of my head. And it's just so happened the whole logic behind Stashfin is those who do not have a credit history or are underbanked by a bank are the ones who can come to us. We are not an HDFC. We will not underwrite you at a high bureau, but we will get you started so that tomorrow, if you want to get an auto loan or a home loan, you are you can control your financial destiny. When I moved back, I could not get a credit card either with my bank or with American Express, which was very surprising. And that's how the notion came about. We are currently 200 people working. We are Series B, and that's how. And I'm going to quickly talk about our journey. We started with 8 people. How you hear about typical startups starting out of someone's home or a basement. That's exactly how we started. And the first few people we hired were tech to check proof of concept. Fortunately for us, because the founder of the company had a financial services background and a network of it, we never bootstrapped. We started with seed funding, which later became Series A, and we are funded by Tencent, KKR partners, and a number of high net individuals in our Series B round. But it wasn't an easy journey. Now we try to call ourselves not a startup, but a real company. We are four years into it. It's we are doing all the compliances, we are giving taxes, we are profitable. So from that perspective, we really do think we are to grow, you need to put the money back, but unit economics always have to be profitable. It wasn't an easy journey in terms of raising funding, going back to the drawing board, thinking what you're doing right, what you're doing wrong. As Mr. Marwa mentioned that edtech, fintech, everyone's trying to raise money. So we were one of the few at that time as well, where the question always asked was, what's your differentiation? And, it's, or make a 2-minute elevator pitch. Those two things are very hard. Indians by communication cannot stop at 2 minutes. It just doesn't happen for us. So it was a constant battle going around the world, meeting folks in the US, Canada, talk about Europe, everything we did to just understand what's happening around the market, what's doing well, what's not doing well, and how we are performing, how to be in front of the curve. So product innovation is something we focus on a lot. Customer experience is something we focus on a lot. And I think that's what's helped us to sail through some of the turbulent times. We've come through 5 credit cycles. We've seen demonetization, we've seen GST, we've seen ILFS crisis, we have seen COVID-1, COVID-2 cycles, and really we are still standing here, standing strong, growing rapidly. We've recently launched a Sentinel program in the company, which is giving back to the society in terms of servicing the armed forces. And we take a lot of pride and encourage a lot of patriotism. And this is something which we think is our USP. It took us some time to get it right, but we are very, very strong about it, and we don't want to stop at just that. We want to go to the police forces, we want to go to the doctors, we want to go to the chartered accountants, only if they take us at the rates we service. But that's how we're thinking about growing the economy. We're not looking at being loan sharks, or we don't think about hard practices. Sometimes the regulators, in the NBFC space, the regulators have been very, very strong, unlike some of the other spaces. So we are very thankful for the regulators for their prompt responses and not painting everyone with the same brush. That's put us ahead of the curve, really. Um, um, team has been a very important factor. We are 3 co-founders in the company, and each of us look at separate functions. I look at the marketing and finance functions, and truly speaking, right now, a lot of my team members have logged in just to hear me talk. And without them, I don't think Stashfin would be there where it is. Without a team, without trust, and of course, Mr. Marwa mentioned conviction is very, very important. And I couldn't reiterate the fact more. There are ups and downs, but keeping strong, keeping your head strong, and trusting each other that you will sail through this is very, very important. Be clean in your financial dealings, work with chartered accountants like RNM to make sure your compliances are in place. That goes a long, long way. Simply because you can't move on in life where you have question marks on your integrity and your books. So that's some of the things which I will tell startup founders. That's not the place where you cut costs. That's absolutely not the place. Pay your taxes, be compliant, because everything else falls in place when your own integrity is very, very high.
Thanks so much for that, Shruti, and thanks for the vote of confidence. I wasn't expecting that, but thanks so much for it. On a lighter note, just to delve a little deeper in terms of your Series A and Series B journey and the seed round, how difficult was that in terms of the valuation number? There's always a tussle, I'm sure, between what you or a founder expects and what the investors are willing to do. Was that a very, very contentious, hard-fought number for you, or was it, as long as you got the right type of investor, the money or the number didn't matter that much? If you could just share some of your thoughts about, how difficult that Series A or Series B or coming to a meeting of minds on that was for you.
Sure. So always, working with the right investor, that should be on top of someone's head. Ability to see through what the opportunity is very important. And I think if you are working with the right investor, they will value you and will give you the valuation. It won't be probably what you're expecting completely, but it'll be close enough because they're looking for a partnership. They're not looking to be a shark. And we had similar situations. We let go of a couple of offers before we actually took the one we had. And it was hard. It was always a question. Are we doing the right thing? Have we done the right thing? What would anyone else come along the way? And fortunately, having that conviction, having the team, having the trust around you really does help. And, it's very, very important for meeting of the minds. And do not work with an investor who is just thinking of you to flip it out very quickly, because you know what? 4 years, 5 years down the line, even though we are just Series B, we do think we are a company and not a startup, really. A lot of livelihoods depend on us, and they should think exactly that way.
Yes, that's super important. I think, the partner management or the investor management is often an underrated aspect, and you brought that out, really well, that, having to continue to deal with the investors on a day-to-day basis is something that you should enjoy, rather than, having your investor call you and you having a kind of a wry smile thinking, oh, not again. So I think that's an important aspect, right? Having to really gel with your investors and just to understand, how was it for you? Was it that the investors reached out to you? Did you reach out to them through some platform? Was it, some common, some common friend or some common person in between who kind of connected you guys? How exactly was it for you?
So both the founder of the company, Tushar Aggarwal, and I come from banking background. So a lot of people after the 2008, 2009 crisis moved around the world. We actually used our own network to go around meeting people and seeing if anyone's doing investments in India. And I will tell you, it wasn't easy. I think we were on vacation, and Tushar took 3 trips from Koh Samui to Singapore in 1 week, because nothing was planned. He just flew, met. And today, one of those investors is our largest supporter and has got us introductions to some of the largest VCs and bankers around the world as we're getting up for the next round.
Fantastic. That sounds like a really amazing story, and that should be an inspiration to us all.
At that point, it didn't feel like an inspiration at all. 3 trips in 1 week during vacation.
Yeah, I'm sure the family wasn't too happy, but I think the inspiring part is that how some of the earlier college connects or your business or work connects, in terms of what you mentioned, your banking background, and the goodwill that you develop over the years really comes to bear, and that is clearly the best way to go about it, to really find somebody personally rather than having to be on that difficult journey. So great. With that, thanks so much, Shruti. I'm going to pass on the baton to our next panelist, who is Prakash, who's going to talk a little bit more on the compliance bit. I think just to connect to what Shruti had mentioned, I think building a large organization for the long term requires you to be on the right side of the regulator. I think she talked about the importance of the regulations remaining clean, remaining forthright in times of crisis, and also regarding the goodwill that one can create through the various charities and the CSR work that one can do. So with that, I'm going to pass on the baton to Prakash for your words. Over to you, sir. Prakash, I think you're on mute.
Now I'm audible? Now I'm audible, sir?
Yeah. Yes, thank you.
Yeah. So to do the ease of business in India, the Indian government has been pioneering projects like Atmanirbhar Bharat, Make in India, Digital India, Startup India, Housing for All, to attract the capital and technology investment in India and to ensure job creation and skill enhancement. There are other projects also like smart city projects, in which the smart city is another innovative mission by the Indian government to attract investments in cities with features of good infrastructure and simple and transparent business processes. Then after the onslaught of this COVID-19, many countries are now looking at moving their business or manufacturing operations outside China, and India is well positioned to emerge as a viable alternate destination. And to promote growth and help Indian economy, many benefits are being given to entrepreneurs establishing startups. The startups recognized through the Startup India initiative are provided ample benefits for starting their own business in India. So just what is an eligibility from a government's perspective? What is the eligibility for a startup recognition? There are certain conditions for a startup recognition. The startup should be incorporated as a private limited company or registered as a partnership firm or as an LLP. The turnover should be less than rupees 100 crores in any of the previous financial years. An entity shall be considered as startups up to 10 years from the date of its incorporation. Then the startup, as already knows, it should be working towards innovation, improvement of existing products, service and processes, and should have the potential to generate employment and create wealth. Then it should obtain a certification from the interministerial board set up for such a purpose. And another condition is it should not have been formed by splitting up or reconstruction of an already business which is in existence. So these are the government's eligibility for what a startup should be. Then there are exchange control regulations. Like if you're investing in India, what are the exchange control regulations which are being put in place? So investing in India by non-resident requires conformity with the India's foreign exchange regulations, specifically the regulations governing FDI. Most aspects of foreign currency transaction with India are governed by the FEMA regulations, and the regulated legislations therein, like the FDI policies. Then the FDI policy has been issued by the Department for Promotion of Industry and Internal Trading under the leadership of the Ministry of Commerce and Industry. So these are the exchange control regulations. So the Indian government has been opening up more sectors under the automatic route to attract the foreign investment. Under the current framework, FDI is being permitted in almost all sectors. So foreign investment into equity shares, compulsorily convertible preference shares, compulsorily convertible debentures, share warrants of an unlisted Indian company, or in 10% or more of the post-issue paid-up equity capital of a listed company on a fully diluted basis is treated as FDI. The investment should be in the form of fresh subscription or acquisition transfer of the existing shares. The FDI can be made either under the approval route or the automatic route. Under the automatic route, the foreign investment can be made in specified activities, sectors, without prior approval from the government or the RBI. FDI in activities not covered under the automatic route requires prior approval from the government. So the RBI has announced a list of clarifications, reforms, proposals, which would be applicable to foreign investments in startups. Some of the key changes are: foreign venture capital investor will be permitted to invest in all startups, regardless of the sector that the startup would fall under. Then the transfer of shares or ownership with deferred consideration and facilities for escrow or indemnity arrangements for a period of 18 months is allowed. Then enabling the online submissions of the A2 forms for outward remittances on the basis of the form, along with the upload submissions of the documents depending on the remittance. Then the Indian startups may also issue shares against any other funds payable by the startup company. To promote investment in startup company, RBI has also introduced convertible notes as a means of finance to startup companies. The note is either repaid on maturity, that is not exceeding 5 years, or converted into equity share of the startup company at the option of the holders. So what happens when a company issues a shares to the startups? What are the compliances? Some of the major compliances, what we need to report to RBI, that I will just dwell into. When you issue the shares, a report to RBI within 30 days in form FCGPR in single master form, along with the valuation report from the chartered accountant, merchant banker is required. So when we issue a shares, a report needs to be submitted to RBI within 30 days in form FCGPR. Then annual return. When there are investments by companies in India, there is an annual return on foreign liabilities and assets. The submission needs to be made by the companies which have received FDI in the previous year, including the current year, on or before 15th July every year on the web-based. All these are now web-based online portal. Then the annual account submission. Everybody might be knowing we need to submit the annual accounts on or before the 30th September of every year. Then if there is transfer of shares, then a report needs to be sent to RBI within 60 days of transfer or receipts of fund, whichever is earlier, in form FCTRS in single master form. So these are certain compliances which needs to be taken care from the RBI and from a perspective. Now coming to taxation. So taxation, generally a startup is being given certain benefits. So what are the benefits? A startup is given a 3 years tax holiday in a block of 10 years. Under Section 80 IAC of the Income Tax Act, any startup that is incorporated after April 2016 can avail 100% tax rebate on its profits for 3 years within a block of 10 years. However, as already told, the turnover should not exceed 100 crores and the company should be a recognized startup. Then what are the other things like exemption from tax on the long-term capital gains? To provide ease in doing business for startups, a provision under Section 54E has been added to the Income Tax Act. Under these provisions, startups are exempt from long-term capital gains. However, this is applicable only if the capital gains that have been invested are part of the fund notified by the government within a period of 6 months from the date of the actual transfer of the asset. There is a maximum cap also here. The maximum cap is 50 lakhs and the amount then has to be invested in the fund for continuously for at least 3 years. So these are the criteria, these are the conditions subject to which there is an exemption from the long-term capital gains. So apart from that, there is a tax exemption to individuals on long-term capital gains from the equity shareholding. If an individual or a HUF who decides to sell their property and then invest the money, they can get a sale to subscribe to a minimum of 50% or more of an existing startup. Then they are exempted from the tax on these long-term capital gains. So this is an initiative to help the individuals and HUFs to invest more in the startups. So this is one of the initiatives. This will attract more investors So that is one of the initiative. Then we have this angel tax exemption, which everybody might be knowing. So the angel tax is nothing but the tax charged on the closely held company when it issues the shares to the resident at a price which is higher than its fair market value. There are certain conditions based on which this exemption is being provided to startups to encourage investments and growth in the startups. So these are the tax initiatives which is being provided. Then we have come to the GST-based compliances. So when a startup is being incorporated, there are GST-based compliances, like if your business or turnover is exceeding 40 lakhs in a financial year, then you are required to get a GST registration. This limit is rupees 20 lakhs for service providers. Then there is a composition scheme also under the GST Act for the small businesses operating in India. Those who are having a turnover of less than 1.5 crores in a year, they can go for a lower amount of tax with the minimum compliances. Then there are monthly returns which needs to be filed. Then the annual return which also needs to be complied under the GST law and the GST audit. Then coming to the intellectual property which has been developed for a startup. The entire idea of the startup initiative aims to work towards innovation, development, and commercialization of new processes, service, or products driven by the technology or the intellectual property. So we need to protect that intellectual property. The first step for any startup is to evaluate and prioritize the IP rights involved in its business. Depending upon the type of industry involved, the IP rights play a crucial role. Sometimes the IP rights are the only assets which is available to these startups. So it can be protected through timely registration by entering into a non-disclosure agreements. Non-disclosure agreements. Then we have this scheme for startups, intellectual property protections under the Startup India initiative. So these are the things which need to be taken care of, because if my idea is there, that needs to be protected because it should not be out of my reach. So that is the main idea here. Now, there are other compliances of the labor laws, but since a startup, there are concessions which are being given to a startups, like various compliance have been simplified for startup to save time and money. So startups are allowed to self-certify compliances through the startup mobile app. Through the mobile app, they have been allowed to self-certify the compliances with respect to 9 labor and 3 environment laws. So these are the things from the perspective of a labor laws where they have been given a concession. So apart from that, the company needs to, like generally when a startup is formed, they prefer the route of the company because the company route is the stable route of formation. So we have the regular process of maintaining the registers, then maintaining the registers, then holding the annual general meeting. All those compliances needs to be taken care on time. So these are the general care which the startup needs to take. Then coming to the contractual obligations, for anything the startup will have, the main thing is here is the employees or the freelancers. So work contracts with employees or freelancers are one of the crucial aspects to be looked into while entering into any venture. So one of the important contract that startups might find it useful to have are the non-disclosure agreements. The startups exposes to risk like the theft of ideas and other confidential business information which might be used against the business. Hence, to avoid such scenarios, non-disclosure agreements or the NDAs needs to be drafted and used by the startups by discussing critical business information with the people outside the organization. So these are the general compliances which needs to be taken care from a taxation perspective or the GST perspective, from the company law perspective, from the FEMA perspective, from the RBI perspective. So these are the things which needs to be taken care. As Shruti pointed out correctly, that compliance is an important thing. So if compliances are being taken care, tomorrow we will not face any problems. So we will be in place with all the compliances and that will not be a hindrance for our growth. So that is the concluding note from my side.
Thank you so much, Prakash, for that. That was very interesting. And you know, like I said, like I always say, the devil is in the details. And the compliance bit may be the boring bit, but it's the boring stuff that in the end holds you in good stead and helps you win those small battles, which in the end helps you win the war. So I think you brought out very good points, Prakash, in terms of the gig workers, the importance of IPR, GST, tax, and FEMA, and so on and so forth. So with that, I'm going to pass on the baton to Mr. Peer, who has the enviable job of talking about the role of CFOs Today when we are in the age of artificial intelligence and artificial intelligence doing much of the mundane bookkeeping and other jobs, obviously the role of the CFO, I'm sure, has changed as well. So with that, I'm going to pass on to Mr. Peer to share his views on what he thinks is, the current role of CFOs in raising funds and how they can help on the startup journey. Over to you.
Thank you, Raghu. Basically, let me start from what Shruti said, that typically a startup starts its operations either from its home or from basement or whatever. That's generally how most of the startups start like that. Okay, when they move further, when they gather some mass after some time, a startup may think of applying what you call appointing a bookkeeper or an accountant to take care of its transactions. What does this bookkeeper generally do? He records day-to-day transaction receipts, payments, bank reconciliation, this and all that. Then the question comes to mind, when all this is going on, why to hire a CFO? But the point here is that whereas the bookkeepers may record your transactions and all that, manage your compliances at the preliminary stage. But what a CFO brings is a CFO brings a strategical financial perspective to the business, which can help you not only in long-term planning, but also help you to optimize the current operations. How does this happen? To understand this, we have to look at what are the financial needs of a business generally. So there's a hierarchy of needs of financial needs of a business. The first one is that what you call transactions recording, receipts, payments, invoicing, all that. The second part is bookkeeping, recording those transactions in the books of account and maintaining books of account. The third aspect is, then the third stage is management reporting. The reporting will encompass both internal reporting, management reporting, and the external reporting for statutory purpose and all. Then the fourth part is the financial management, which is tax planning, budgets, forecasts, performance targets, and variance analysis. And on top of that comes strategic planning, which involves, say, capital structuring, mergers and acquisitions, pricing strategy, and all that. So the startup, in fact, it has to go. In fact, if it has to grow, it has to go all through these stages. Well, all these operations, these things cannot be taken care of by an accountant. But what happened throughout the world last time? There was a pandemic and all that. So all the companies started, all the even startups, every company, they started looking inwards, let us look down costs. So in this perspective, as a startup, you think, yeah, why should I hire a CFO? Because it's a very costly resource. What do I get out of it? So the point here is that, yes, CFOs are costly resource. That is the concept, how this concept of virtual CFO came in. That, as I told you, a business does need a CFO to give it a strategic perspective and to help it in long-term growth. So if you establish it right from the start, it will right at the start, it will help your journey to be very smooth. So we have come in with this concept of virtual CFO. So what happens? You employ a CFO, you get all the benefits, you capitalize on his expertise, on his advice, and whereas you cut down on the cost, it's only a fraction of the cost involved in hiring a CFO. So that is how this concept came in. And as regards now coming to the other part, that is fundraising for the CFOs, as Raghu listed various steps, how to go about it, what are the different kinds of funds and all that. I'll only limit my discussion here only to what is the role of a CFO to all this. A CFO is of a pivotal importance in fundraising because he is the person who provides a guidance and support to this function. See, as a startup, as a CEO, as an entrepreneur, you have a story to sell. But that story to sell will not sell with the investor unless it is supported by facts, figures, numbers. The numbers should add up. It should tie up with the financial, information that you give in the pitch desk and all that. The numbers have to complement each other, and even if there are contradictions, these have to be explained. So that first part is, and what a CFO will do, he has to estimate make complex calculations, what is the amount of cash required, how it will be spent, and that has to be incorporated in the financial deck. What you present to the investor, this is the money we want, this is how we want to spend it, and how we go about it. This is the first step. Now the second part is now making the, what you call, first part is determining the cash and this cash amount required. The second part is the due diligence process. Due diligence is a very, any investor will invest money with you when he goes through a thorough due diligence process. He'll look at your compliances, he'll look at your pitch deck in detail. He should be satisfied about the story. Yes, it's a fact that any investor invests in the CEO and the management team, not on the CFO per se. But CFO is very important because that which he helps to put that point of view across what a CEO wants to sell and to put it in a language which is understood by the investor and which gives him confidence. That is how the role of CFO comes in. Okay. And then if you want to go in for institutional investors, you want to go in for institutional investors, a CFO generally has some amount of experience. He has his contacts with the institutional investors, and also he can put you across to them. He can get your meetings arranged, and he can get you the best terms and conditions. And he'll see that the investment that is coming to you is coming on the what are the terms and conditions which are most favorable to you. That is why the role of a CFO comes in all this process. So even when the investors are on board, the role of CFO is in fact increases further, because there are then further what you call reporting requirements come in. Reporting to investors, reporting to whatever investor, whether it's an angel investor or it's a financial institution or it's a bank or whatever. So the point is that you have to, that reporting requirements will go to meet those reporting requirements. You have to streamline and upgrade your internal systems, procedures, internal controls, put the things in place, ensure statutory compliances and all, so that the company is in a position to develop, it has the necessary backend to develop that kind of output which is required, which would be required by an investor to periodically evaluate the performance and look how his investment is doing. So that is how a CFO can add value to the startup, how it can help in getting the money, and how it be beneficial for the long term, in the what you call long term for the startup. And again, that if you as a startup, you cannot go in for considering that these are very costly resources, hiring a full-time startup. You can go in for virtual CFO services where you can get all these benefits, advantages at a fraction of the price.
Thank you so much for that, Mr. Peer. I think that was all very good points that you raised, and whilst you were giving your talk, we also got the opportunity to share 2 poll questions. And just for the audience's benefit, the first poll questions was on the fintech, and clearly the majority feels that the fintech is giving a run for its money to the banks and competing very well, and that is going to continue to happen in the future. And the second poll question was regarding the compliance, that whether many people are actually taking the tax exemptions that the startup schemes offer. And again, the thumping majority saying that we don't want to take those tax exemptions from the government. And that's again sort of a commentary on the doing business in India, that how startups just kind of want to stay away from whatever government regulatory functions, and they're still kind of suspicious of that. I think that brings us to the next question, which is the third poll question on the CFO role, which is on your screen right now, which is what, according to you, is the main role of a CFO or a virtual CFO? Is it the bookkeeping and compliance? Is it decision making? Is it the cash flow management? And the results are coming in, and I think as per the majority, it's the decision making and the cash flow. The results on your screen. And bookkeeping and compliance is obviously becoming lesser and lesser of a area that the CFO is playing in. I mean, although maintaining oversight on books and compliance is an important area. So I think with that, thank you once again, Mr. Peer, and we're over to giving the mantle to Mr. Sunil Chawla about the wider ecosystem of the venture debt and the early stage equity funding in India, and what, based on his illustrious experience, he feels is the landscape going forward. Over to you, Sunil ji.
Thanks very much, Raghu, and good afternoon, everyone. I think my job has been made much easier by the nuggets of wisdom shared by Raghu and my fellow panelists, Shruti, Prakash, and Mr. Peer. So let me dive into the subject straight away. So indeed, what we have seen in the last 12 months or so is totally unprecedented and beyond anybody's imagination. So while we have been in the midst of the worst pandemic in a century, early stage funding is breaking all sorts of records. Now, this may sound paradoxical, but I think there is some logic to it, and let me try to explain. So with the lockdowns, as people spend more and more time indoors, a lot of businesses suffered, while many others actually flourished. For example, while cinema halls shut down, OTT content found huge demand. While restaurants were closing down, food delivery apps saw good demand. Retail businesses saw demand plunging, but e-commerce and logistics companies saw demand skyrocketing. While airlines and hotels found passengers and guests hard to come by, and everybody learned to work from home, gaming companies, content and music companies, OTT media companies like Netflix, Amazon Prime, etc., they saw unprecedented usage and customers. Schools were closed, but edtech companies had a great time. Customers couldn't visit their banks, but fintech companies flourished. So there you have it. No surprise then that this is turning out to be a record year for fundraising by startups. Raghu gave you the figures I need not repeat, but suffice to say, we'll end this year certainly with a huge margin or a huge lead over the previous high in any year in terms of fundraising for startups, having already crossed the earlier figure of $13 billion raised in 2019 by a big margin. So when you read or hear about hundreds of startups getting funded, it all sounds so easy, doesn't it? But let me assure you, it is not so. And a lot of effort goes into building most of these companies. In many cases, the founders spend as long as 2 to 3 years to perfect their business model and the technology on which to base their businesses. Now, remember, all this time, there is no revenue. So there is no salary, no drawings for the founders at this stage. And at the end of this all, there is no guarantee that you will be able to raise funds. For every startup that gets funded, there are perhaps a dozen others which are not able to raise money and find no takers. In fact, as per a recent study by CB Insights, an American analytics company that specializes in analyzing and studying venture capital startups and the like, top reasons startups fail. The number one reason why startups fail, well, no prizes for guessing, is that they run out of cash or they fail to raise new capital. So there you have it. Now, funds are the lifeline of a startup as much as they are for any other business. So what is it that ensures success in fundraising or at least improves your chances of getting funding? People will talk about a lot of things, but to me, there are two and only two things that most investors will focus on initially. One is the founder and the second is the idea. As far as the founder or founders are concerned, the past track record is key. If you've already had one or two startups and successfully exited those, it's a plus, but obviously it is not essential because as we all know, hundreds and thousands of first-time entrepreneurs have been raising money successfully. The founders need to have absolute clarity of thought and they should know the business like the back of their hands and be very clear about what they want to deliver to their customers or clients. Above all, what any investor looks for is the passion and energy that a founder brings to the startup. As far as the idea is concerned, it has to be something that is solving a problem or providing a better way of doing things. It need not be unique. Let me tell you, I mean, a lot of people will say, what is unique about your company? Well, I mean, a unique business is very, very rare. So if there are a few others doing the same thing, it's fine, so long as the addressable market is large enough for you to be able to get a decent share and be able to scale up your business. One thing that investors don't like typically is if you are in a very highly regulated business, or if you are highly dependent on the government for business. So unless it can't be helped, try and stay away from such businesses. So how to prepare for fundraising? How do you go about it? What are the things to do? What are the things to watch out for? Well, some of the things are obvious. Once your product or service is ready and you're ready to go out and start fundraising, the first thing you need to do is to put together a pitch deck. Now, a pitch deck is something that gets mailed to an investor ahead of the meeting, or is shared during the first meeting. So it's really your first and best chance to make an impression. So make sure that the pitch deck you prepare is slick, it's to the point, and yet it covers all the information that an investor seeks. So for instance, you have to talk about the business proposition, the product or the service or the process, the problem that you are trying to solve, and the USP of your product. What is the total addressable market, and how much market share can you realistically hope to get out of that? You may share the pipeline of orders or contracts if there is one. But if confidentiality is an issue, you could either mask the names, or maybe even keep it out of the pitch deck and just talk about it verbally when meeting the investor. You need to inform the investor as to what stage are you at, what all has been done, and what needs to be done further to scale up the business. You need to talk about the competition, who all are there, and how is it that you differentiate yourself from the competition. Brief biodatas of the founders are important, as I mentioned earlier. You need to talk about the team, and if some of the key members of the team hold equity in the company, that is a big positive. So please do talk about that. You have to mention the details of any earlier rounds of funding that you may have raised. You need to provide the financials of the company unless it's a pre-revenue company. And of course, you need to project the financials for the next at least. And when you talk of a valuation number, be prepared to defend it. Be sure that you know that it is in line with market and not totally outright. All said and done, make sure that your pitch deck is no more than 15 to 18 slides. If required, seek professional help from firms like RN Marwa and Company and others. I mean, Mr. P talked about your virtual CFOs. You could hire one of those firms. So that's one thing. The other is having to prepare a business plan. So prepare a realistic and concise business plan. Again, that is somewhere something for which you might need professional help, given the fact that all startups are unable to afford a CFO. So those are the obvious things. What else should you be doing? Well, firstly, reach out to angel investors, VC funds, etc., with a brief introduction of yourself and the company, and seek a meeting or an opportunity to present the idea in more depth. Make sure to register your company as a startup so you get all the benefits that startups are entitled to, and Prakash spoke about that at length. Network with other startups and founders, other startup founders and angel investors and VC funds, etc. Most of you would know that often there are programs where startups are invited to come and present to a select set of investors. Make sure you are seen in those. Visibility is very important. Be open to suggestions. There will be times when you will meet an investor who will not invest in your company, but he may make some invaluable suggestions or give you some excellent tips. Remember, most angel investors and VC fund managers, they come with years of experience of working with startups. Be flexible enough to pivot to meet changing market needs or to adapt to a better way of doing things. Very important, don't be disheartened if some investors say no to you. Even some of the best startups were turned down by some investors early on. Also important to keep in mind that many investors have their own reasons. For instance, there are some who will not invest in a company that has a single founder. And so they insist on 2 or more founder team. There are, there may be certain sectors that an investor may not want to invest in, or the investor may have already exceeded or reached its limit for investing in a particular sector. So all of these things are what you need to keep in mind. What is it that you should not do? So a couple of pitfalls to avoid. One is again something that's become a fashion these days. You see all these startup founders, comparing notes with others and thinking that their valuation has grown by a few $100,000 from the previous week or the previous fortnight or whatever. Stop chasing valuations. So long as you focus on your business, so long as you have a good business model and you're honest to your startup, valuations will follow. A lot of people are averse to diluting. Again, I would say don't do that. It is always better to be a 30%, 35% owner of a large business rather than clinging to your stake and being a 90% stake owner in a very small business. Now, there are any number of examples of companies which have gone out and raised money, not worried about the dilution, and they've actually gained from all that. Prime example is Bharti Airtel. By the time Bharti went public, the promoters were already down to less than 40%. And just see where they are today, even with a 30, 35% or 40% stake in that huge company, it's worth several billion dollars. The other thing that I would suggest that you avoid is getting too close to your product or service. Now, what do I mean when I say that? While single-minded devotion and dedication to developing your product or service is great, but at the same time, don't lose sight of the market. Don't lose sight of what the competition is doing. The worst thing that can happen is that you spend months and months working on your product or service, and by the time you finish, you realize that the market has changed and your product probably has no value. Or somebody else has developed a similar product at a much lower price, or maybe even a product which is, better than yours. So those are the things I would suggest that you do or not do in order to be able to raise VC money or money from angel investors, etc. As far as venture debt is concerned, I would say don't worry too much about that. Once you've raised VC funding by way of equity, venture debt will follow. Most venture debt funds actually do exactly that. They follow VC funds into companies, and they would lend only to a company that has raised institutional money. Also, keep in mind that you don't go to a venture debt company or a fund at a time when you're running out of cash. That is not the time when they're going to lend to you. Typically, venture debt funds will lend to you around the time or just after you've raised money from a venture capitalist or any other institutional investor. The idea being to prolong the runway for you to become cash positive or till the time you raise your next round of capital. Of course, venture debt funds step in, and they are a great source of capital for startups, given the fact that most banks would not lend to you. Startups typically don't have much to offer by way of collateral, so venture debt funds will will lend money to you without asking for collateral. So being a clean or an unsecured debt, the interest rates may be a little on the higher side, typically ranging from 13 to 17, 18%. But I guess given the ease with which you can raise money from a venture debt fund, once you've raised venture equity, I think it's worth it. One other thing that you may like to keep in mind is that typically most venture debt funds will reserve an option to subscribe to a small equity stake for up to a certain period of time, which they will do at the last valuation at which you raised money. So that is all that I have to say, and I hope that this is useful to some of the startup founders, etc., who are on the program today. Thank you.
Thank you so much for that, Sunilji. It was truly enlightening. I think you shared a lot of keen insights. And for me, the one that really stood up is don't get disheartened when investors say no. I think that's something that each of us as entrepreneurs, founders, or whatever in our own journey have to face. The ups and downs of things that work out and others that don't. So I think that's a major thing, that stick to your guns and things will work out. Whilst you were talking, we also did a poll where, we asked the question in terms of what is the best funding source, and 50% of the audience said VC. So venture capital still seems to be the go-to, and angel and crowdfunding as the next best option. I think that may be a commentary on the amount of money bags which are floating around with venture capitalists these days. And, people think that that's a low-hanging fruit. But thank you for everybody. We had a couple of questions for the panelists, one on Stashfin particularly, which Shruti has answered as a Sunicorn. Shruti, would you like to say anything further on the Sunicorn status? Over to you, Shruti.
So we've been recently rated as a Sunicorn in the fintech space. So all I'll say is stay tuned here, subscribe to our LinkedIn page, subscribe to our Facebook page, and you'll be hearing more from us.
Super. Best of luck to you and Tushar for that Sunicorn becoming a unicorn very soon. And next question was, by somebody on the startup registration, that how easy is it and where do I go to do that registration? Prakash has answered, it's on the DPIIT site. Prakash, would you like to add something further to that? You're on mute, Prakash.
So we have to get the registration from the DBIIT. This is an interministerial board. So to get the concessions and all those things, it should be a recognized startup. Once the DBIIT recognizes a startup, then we can avail the tax concessions and all those things.
Okay. Thank you so much. Thank you to everybody. And I hope there are no other questions that anybody else has. Would the panelists like to say any last parting comments, or maybe you've got a question for one of the panelists? I'm going to just wait a while for somebody to maybe, in case they have a comment. No. Okay. With that, we're going to bring a close to this. Thank you so much. Apologies for running a bit off the timeline. We like to be Swiss in our timing, but thank you so much, everybody. And thank you for the panelists once again for joining us. Thank you to Samiksha for putting this all together, and stay safe, stay healthy. Thank you. All the best.
Thank you. Thank you all. Bye.
Thanks, everybody. Bye-bye.